This is Trade Alive with IUX, where markets come alive and trading gets real. Let's go live.
This podcast is brought to you by IUX Trading Platform, elevating your trading experience.
Hello, listeners, and welcome back. Today, we're going to talk about something incredibly frustrating, something that has probably cost every single one of you money. It's a core problem in trading that isn't about charts or indicators, but about you, the human. In the world of trading, there is a distinct difference between the market value of an asset and the personal value a trader assigns to it. Now, logically, these two numbers should be identical, right? Assets are fungible, meaning they're interchangeable, and the market price is the only price that matters. But psychology, my friends, tells a completely different story. Have you ever noticed this? The moment you open a position, something shifts in your brain. That ticker symbol is no longer just a piece of data. It instantly becomes my trade. And this psychological attachment leads directly to one of the most expensive errors in all financial markets: overvaluing your own trades. This phenomenon is why traders stubbornly hold on to losing positions, often months after the technical reasons for the trade have completely vanished. They genuinely believe the market is, quote, wrong, and that their position is intrinsically worth far more than the current depressing price. This specific cognitive distortion has a scientific term. It's called the Endowment Effect. The name stems from the idea that merely being endowed with ownership, just receiving the asset, causes an immediate, often totally irrational increase in its perceived value. For a trader, that moment of clicking buy serves as that act of endowment. The position instantly shifts from being an impersonal market opportunity to a valued personal possession. And boom, sound of finger snap or light clap, the bias is triggered. To survive in the long run, we must understand this powerful emotional bias and learn the only strategy that allows us to cut losses without regret. So let's dive deeper into what this actually means. The root of this problem is, as we said, the endowment effect. Behavioral economists, specifically pioneers like Richard Thaler and Nobel laureate Daniel Kahneman, have demonstrated this phenomenon countless times. This bias is directly linked to profit theory, which states that the pain of avoiding a loss is far greater than the pleasure of achieving a gain. Listen to this famous experiment that proves the theory. People were given a simple coffee mug. After owning it for just a few minutes, they refused to sell it for less than $7, even though they admitted they wouldn't have paid more than $3 to acquire it initially. I mean, think about that. The simple act of ownership immediately doubled the perceived value of the asset. Now, why does this happen? This disproportionate valuation is deeply tied to loss aversion, the central principle that the pain of giving up the asset is roughly twice as strong as the pleasure of receiving cash for it. This 2-to-1 ratio is the formula for emotional damage in trading. Psychologists call this possession utility. Once you click that button, your trade is no longer just data. It becomes psychologically integrated into your identity and your portfolio. We assign a higher value to something simply because we feel entitled to it. It is ours. Therefore, the act of selling is perceived by your brain not as a calculation of capital, but as a painful deprivation of something you already mentally own. This creates the fundamental conflict in trading, the price reference point shift. The moment you acquire a position, let's say you buy at $150, that acquisition price instantly becomes your irrational reference point. Any movement below $150 is immediately registered by your brain as a loss. This happens even if the fundamental value of the company drops to $130. You are not viewing the asset fungibly, as the market does. You are viewing it as a unique piece of your property that is currently undervalued. This irrational adherence to the entry price builds a high emotional barrier against selling. It forces you into cognitive dissonance, where your mind works overtime to defend the past, the $150 entry, against the present, the $130 reality. You literally have to construct a complicated lie to avoid the simple truth that the trade is broken. In trading, this bias is absolutely deadly. Let's make this real. Let's look at a concrete example of the psychological shift in action. Imagine you buy shares of Apple, AAPL, at $150. You're excited. It's your position. Then a week later, the CEO unexpectedly resigns, and the stock drops to $130. Your logical self knows this is a catastrophic fundamental change, but your emotional self, your endowed mind, thinks, I bought it at $150. Therefore, it's worth $150. You immediately begin engaging in cognitive dissonance as your mind struggles to reconcile two conflicting thoughts. I am a smart trader versus my trade is losing money. To resolve this mental conflict, you decide to blame the market. This leads to what I call the filtering lie. You ignore the CEO resignation, the objective bearish news, and instead desperately overemphasize any little bullish sign, maybe an obscure analyst upgrade from 2 weeks ago, placing a higher emotional value on your open position than the market does. You are literally filtering reality to protect your $150 entry point. This is why traders often set their selling prices too high or hold on past any rational exit point. It even has a cultural manifestation. This bias is so prevalent in modern markets, often dubbed HODL, or holding on for dear life. This is the endowment effect, the belief that your asset is intrinsically better than the market's price simply because it belongs to you. The pain of accepting the loss is so intense that holding that position at $130 locks up your margin, locks up your emotional energy, and destroys your opportunity cost. You are paying for a seat on a roller coaster you don't want to be on while missing out on a dozen better confirmed setups. So that's the trap. What's the antidote? How do we neutralize this emotional poison and reclaim our capital? To combat the endowment effect, you need an objective framework. But before I give you the specific tool, we have to dismantle the biggest lie traders tell themselves. You know the one I'm talking about. It's the whisper in your ear that says, "It's not a loss until I sell." I have to be the bearer of bad news here. That is a complete myth. This is what financial psychologists call the paper loss fallacy. We try to categorize our losses as unrealized or paper to protect our ego from the sting of failure. But here is the cold, hard reality. Your net worth is marked to market every single second. If your account was worth $10,000 yesterday and it's worth $8,000 today because of an open losing position, you have lost $2,000. That money is gone. The only choice you have left is to whether stop the bleeding or let the wound get deeper. This behavior is driven by what experts at Charles Schwab and behavioral economists call the disposition effect. It's this nasty little tendency in our wiring to sell our winning trades way too early, to lock in that feeling of being smart, while holding our losing trades indefinitely, hoping to avoid the feeling of being wrong. We hold the loser because realizing the loss feels like an admission of defeat. But in professional trading, hope is not a strategy. It is a liability. Furthermore, we have to talk about opportunity cost. When you leave your money stuck in a zombie trade, a trade that is going nowhere or slowly bleeding out, that capital is being held hostage. It's dead money. You aren't just losing the value of that specific trade, you're losing the ability to use that capital on a fresh A+ setup that is happening right now. You're literally missing out on the next big winner because you're too stubborn to let go of the current loser. So how do we break this cycle? The absolute best strategy to cut losses without regret involves a simple, powerful mental exercise called the re-entry test, or sometimes the overnight test. This is your lifeline. When you're holding a losing position and you feel that tightness in your chest, that hesitation to close it, I want you to physically stop what you're doing, implement your 5-minute cool down, and ask yourself this specific, non-emotional question. If I did not own this position right now, would I buy it at the current price? Let's go back to our Apple example. The stock is at $130. The CEO has resigned. Momentum is gone. If you had cash right now, would you initiate a new buy order at $130? If the honest answer is no, because the trend has broken or the fundamentals have changed, then you must sell immediately. If you wouldn't buy it today, there is absolutely no logical reason to hold it today. This moment of decisive action shifts your locus of control. You stop being a passive victim of the market and you become an active manager who is mastering the process. Furthermore, holding a losing position puts you in a deep, dark hole mathematically. Let's look at the nonlinear danger of delay, known as the inverse return rule. If you take a 10% loss, you only need to gain 11% on your remaining capital to break even. That's a reasonable hurdle. But if you let that loss balloon to 50%, you must gain 100% just to break even. Woo! You see the urgency. That demonstrates the mathematical necessity of realizing losses quickly and decisively. Every dollar you recover from a losing trade is a dollar you don't have to work twice as hard to earn back. This leads to the rule professionals live by. Sell your losers, not your winners. The emotional bias tells you to sell the small winner for a feel-good profit, while holding the big loser out of hope. The rational approach is the worst first rule. Purge the trades that have proven their thesis is broken. By treating every single moment as a new decision, you detach your ego from the trade. You stop defending the past, that painful $150 entry price, and you start managing the present, the actual objective reality at $130. This mental shift allows you to execute your stop loss not as a failure, but as a disciplined business decision, a necessary capital offset. This action instantly frees up your funds and your crucial emotional energy. This is the opportunity cost in reverse. You are freeing up capital to go pick the ripe apple instead of holding the rotten one. View the realized loss instead as tuition paid to the market university. You paid the fee, you learned the lesson, and you protected your core capital. By valuing your precious capital more than your current flawed positions, you ensure the one thing that matters most: longevity. So let's bring this all home and really crystallize what we've learned today. We've discovered that the tendency to overvalue our own trades is not a sign of bad analysis or low intelligence. It is a sign of being human. It is the result of the endowment effect, a deep cognitive hardwiring that tricks us into believing our positions are special simply because they are ours. It causes us to violate the rational economic model and ignore the terrifying reality of the inverse return rule, where a small loss can quickly balloon into a hole so deep you can't climb out of. The solution lies in a radical shift in identity. You must stop acting like a museum curator, guarding your precious collection of stocks as if they were rare artifacts. Instead, you must start acting like a warehouse manager. Your portfolio is just liquid inventory. If the inventory is rotten, if the thesis is broken, you throw it out. You don't get sentimental about inventory. The tool to achieve this is ruthless detachment via the re-entry test. Make this your daily ritual. Stop looking at your entry price. That is a ghost of the past. Look at the current price. That is the only reality that matters. When you finally click that sell button on a loser, I don't want you to feel shame. I want you to feel relief. You didn't just lose money. You bought freedom. You brought back your mental clarity, you stopped the opportunity cost, and you freed up your financial firepower for the next A-plus trade. View that loss as a disciplined business decision, a necessary capital offset. Think of it as tuition paid to the market university. You paid the fee, you learned the lesson, and you protected your core capital. By valuing your precious capital more than your current flawed positions, you ensure the one thing that matters most: longevity. If this episode gave you valuable insight, you can click like, subscribe, follow, and share it with another trader who might need this reminder. In the next episode, we'll dive even deeper and explore more. Thank you for listening. See you in the next episode. Goodbye.
You've been listening to Trade Alive with IUX. Ready to put these insights into action? IUX is here to power your next winning trade.